Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. Today is December 7th, and this is the 7th video that I'm making for the month of December. Yesterday, we started the conversation around what the criteria is and how do we calculate reverse mortgage loan amounts. And today, we still are, but we were going to discuss what the comparison is between the reverse mortgage loan amount and the determination of the traditional forward mortgage loan amount. And initially you might dismiss it and think, what does it matter? I just know what my loan amount is. But it's actually very crucial, and that's why I actually hesitated a moment ago when I said, today we're going to talk about the forward mortgage calculation. Because when I unfold everything and I'll present it to you, you'll see that it's so much more important, and the consequences of it are so much more significant than just what the loan amount is. And it's in going deep and doing a comparison and contrasting these two products that you really get to see and appreciate the versatility and the flexibility of the reverse mortgage and why I'm such a big proponent of it. So as you can see behind me, there's a lot of stuff going on, and that's why I'm going to have to break this video into subparts. But what I wanted to do was pick up where we left off yesterday, and we talked about the reverse mortgage yesterday, and we said that the determination of the loan amount is going to be based on the appraised value, which the benefit of the reverse mortgage is that once you appraise the property today, it locks in that value today. And as we discussed yesterday, right now we're in this situation where property values are declining and interest rates are going up because the Fed chair has decided to use his power of interest rate increases to try to tame inflation and bring it down to 2% from 8%. Well, really the only tool that he has to do that are these interest rate hikes. And as the rate goes up, less and less power is available for people to consume, to buy homes. And that's making home values come down. So when you do a reverse mortgage and we appraise your property today and we lock in the price, we say that your property appraised at $1 million. If 3 months from now, 6 months from now, 9 months from now, because of property values declining 10, 15, 20%, you lose $200,000 of home value appreciation that you enjoy right now. Your reverse mortgage won't be affected because your line of credit, which is derived by your property appraisal, has already been locked in. And that's a significant difference if you think about it, because if you're at the age of 65 to 75, 80 years old, and you've enjoyed housing appreciation and home values in the next 6 months to 2 years can drop 10 to 30%, that's a significant amount of your housing value wealth that is going to evaporate. And the only way that can be brought back is through time. And how long it takes is something that you're going to run against. So the opportunity cost of losing that home appreciation, wealth or equity is what we're trying to preserve. And with the reverse mortgage, you immediately get that because, like I said, we determine the value, we determine the loan amount, and if you are eligible for a line of credit, everything is set and future value depreciation will not make a change. The second thing we talked about is the reverse mortgage program and rate. And what we talked about is that there's a fixed rate with reverse mortgages and there's an adjustable with the reverse mortgages. And the benefit of the adjustable, and the reason somebody would do the adjustable, is that they like to take advantage of the power and the flexibility of having the line of credit. And we said that ideally there's 3 borrower types. Borrower 1, neighbor 1, has his house free and clear, and he gets a standby line of credit. Neighbor 2 has a small balance, $100,000, $200,000, and we'll pay that mortgage off for him so he won't have a mortgage payment. And with the remainder of his equity that we can put into a reverse mortgage line of credit, he'll have a line of credit. And we said the third neighbor will pay off his existing mortgage and may not have access to a line of credit right now. However, for tax reasons, if there's a benefit for him to use his line of credit in a way that he could pay down the line of credit, then some of that money that was on his line of credit as a debt will be shifted over to the credit, and now will be able to be used for future appreciation or future use. And that's something that a traditional mortgage won't give you. And that's, again, a huge plus. Then we talked about the borrower, and we said that the qualification is age 62 or older. And we said that if a spouse is a younger spouse, so in my example, the husband was 68 and his spouse was 58. We said that because the husband is 68 and he qualifies, then the wife at 58 is going to be on the loan and on the program. And again, this is one of those factors that people were initially very hesitant about. And back in the day when the program wasn't developed, we would take the younger spouse off in order to help the husband, the older spouse, get the most amount of money available from the reverse mortgage. And that caused complications. But that's not the case anymore, because even if you have a younger spouse, here the spouse is 58, what we can do is put her on the loan and we'll do the loan amount based on the younger spouse, which is 58. So we talked about, once we do the reverse mortgage and we determine what the loan amount is and whether they're eligible, then that's it. That's all there is to it. They have the option to pay monthly mortgage payments. They have the option to have the line of credit. And the credit score is not going to be so much of a determinant factor in terms of getting the person out of the option of getting reverse mortgages. Not working and having employment income is not going to be a consideration. Not having significant reserves is not going to be consideration. Not having a substantial amount of monthly income is not going to be a consideration. And that all has to do with the fact that you need all of this money and reserves in servicing your monthly mortgage debt, both in its payment form and its total loan amount. And that's what I really want to talk about in this segment, about how the compare and contrast is with a traditional mortgage. So with the traditional mortgage, again, we do the property value appraisal. That's a given. And then we look at the program and the interest rate. Now, to determine the program and the interest rate, we need to peel back some layers. We need to see what type of a mortgage you're going to get, because unlike here where it's just a fixed and adjustable, here you have a lot of variety. You have a 30-year fix, a 15-year fix, then you can have a 10-year fixed rate, a 7-year fixed rate, a 5-year fixed rate, or an adjustable. And your rates are based on these criteria. And this is something you have familiarity with, because at this point in your life, you've done purchases or refinances. So these terms and these ratios and these numbers that I talk about are very familiar to you, so I don't have to go in super detail that I do as I do over here with the reverse mortgages. So obviously your credit score is going to be a significant point in what kind of a rate you're going to get. And we used the example yesterday that if you have a FICO score that's 800, that's going to put you in a different tier than if your credit score is 580. So while here, if you have a 650 FICO score, it's going to be a credit ding, they call it credit ding, and affect your interest rate. Here, having a 580 or 650 FICO score is not going to be a credit ding. It's not going to determine your interest rate to be higher. The other consideration here, we have loan to value and combined loan to value, and we refer to that as LTV or CLTV. So depending on the program that you're getting, you may have a first mortgage that's at 80%, and then you put a 10% line of credit behind it, which is the HELOC. So you have an 80% LTV and now a 90% LTV. Now, if you have to think about it, the home value, which is the 100%, that means that you've eaten up 90% of the home value through putting mortgages of first and a second on it. Or if you don't have a HELOC, you have a first mortgage, you can go up to 80% of the value. So that means that if future home values go down, like they did in 2008, 2009, 2010, that's where you get in that situation where you're in an inverse relationship. And those people, if you think about it, in 2008, 2009, they didn't have reverse mortgages and they went upside down. So this is what I mean by the fact that I say home appreciation is not in your control and getting housing wealth is not within your control. The best you can do is make your monthly mortgage payments and have your principal come down on your loan amount minimally and minutely. And that's what this whole conversation is. That's what this next video that we're going to do is, because we're going to do a compare and contrast between how your loan to value ratios affect your equity and affect your housing wealth appreciation between a reverse mortgage and a forward mortgage. And that's why I'm so confident in saying that if you're thinking that you're going to lose all of your equity, there's another consideration or several other considerations that you need to be considerate of. So going back to this 80%, 90%, depending on what the program guidelines are and depending on what you're doing, that's going to determine how much equity you're going to actually have and how high you can go. Another consideration becomes in terms of within the loan, what are you doing? Is this going to be what we used to call rate and term, which is all you're doing is taking advantage of a lower interest rate? Or are you doing a rate and term and you're getting some money out? In other words, if your interest rate was 5% and now market is at 4%, are you simply refinancing to go from 5% to 4%? Or are you going from 5% to 4% and your house has appreciated and you're pulling out an extra $50,000 to $100,000? Depending on what you're doing, that again has a change in what your interest rate is. And then we have here the federal rate changes to the program. And that has to do with the longer the loan amount is, the higher the interest rate is, because the more the bank is taking as security in having that interest rate be out. So a 30-year fix is always going to be a higher rate than a 5-year fix. A 15-year fix is going to be lower than a 30-year, but the payment on it is going to be almost 1.5 times more because you have a significantly shorter period of time. So depending on what kind of a loan program that you're getting, your interest rate is going to fluctuate. So this entire top section has to do with pretty much your interest rate. Now, this section in the bottom has to do with the borrower and the co-borrower and their qualification. Here we had a pretty simple qualification. We said, you have an appraisal, which we do here. We have the program. It's either adjustable or fixed, and to a certain extent, you have it here, adjustable or fixed. And we said the age of the youngest borrower is going to determine what's going to happen. Here, now you're looking at the borrower and the co-borrower. Obviously, their credit was incredibly determinative. You couldn't dismiss it. In fact, there's some loan programs that if you have a below certain FICO score, you won't even qualify for the mortgage. So here, for the borrower and the co-borrower, what are we talking about? Well, the biggest determination is your income and your employment. You have to have a secure income, monthly income, because you're going to have to finance a significant amount of money and service that debt every month. And your income and your employment is key for that. In addition, your reserves and your savings are significant, because if you lose your income, God forbid, you need to fall back on your reserves. And when the bank sees that you're living paycheck to paycheck and your income and your employment history is touch and go, well, that doesn't give them a warm, fuzzy feeling to lend you $500,000. So your reserves and savings are significant. Another consideration is your DTI, or your debt to income ratio. There is your housing costs, and then there's your other expenses. So your housing costs has to do with your principal and interest payment, your taxes, your insurance, your homeowners association, everything that bracket that makes up housing expenses. Then there's your other expenses. There's your car payment, there's your student loans, there's other things, your credit card payments. So when I was doing the traditional forward mortgages, we had to get some sort of an equation going of how much of a person's income is going towards servicing their mortgage debt and how much of their income is going to service the total debt. And even if they had a good income and they had a good FICO score and they have a good reserve, if the debt ratio was beyond what their numbers were, they couldn't qualify. So what they would have to do is they would have to cut back the loan amount, or have the person artificially bring a lot more money in to change some of the numbers. We had clients that had $20,000, $30,000 in credit card payments. Well, if you have a $20,000, $30,000 credit payment that's revolving, that generates an interest-only payment. That's almost like having your HELOC. And if you think about that right now, which is another video that I'm going to do right now in December of 2022, I was shocked because I sat with a client and the interest rate on a credit card that they had was 30%. And it made me think, and I went and looked at my own credit card, and I pay it off monthly, but my credit interest rate that the bank was charging was 29%. And I was floored. So I called the bank. I said, is this a mistake? Because I don't have the kind of credit that warrants giving me 29%. And she immediately went into this whole prepared speech of, well, the Fed has increased the interest rates and that's why we're charging. Well, the Fed interest rate isn't governed by credit cards, and that's not what its direct link is. And certainly the Fed interest rate isn't at 30%. It's an opportunity for them to charge 30% for people who carry a large amount of balance from month to month, and that can cause a significant financial distress when you're a senior. And if you have $5,000, $6,000 a month, which is what I read the average revolving balance for seniors are, because they're on a fixed income and they have reduced income coming in. So in order to make ends meet, they're putting $200 here, $300 there. And next thing you know, they're at $6,000. Well, if you're at $6,000 at 30%, that's a $180 service fee that you're paying for that interest rate at 29 or 30%. That's cutting into your Social Security income. But again, this is the importance of having this overall picture. So this debt to income ratio is really key. Now, the reason I went into this depth to this, and I'm going to go even deeper, is conceptually, this is really important to understand this, is that if you're of the mindset, you're sworn against the reverse mortgage, and you're like, Benny, there's no way in hell I'm going to get a reverse mortgage, and my mortgage is the way to go. God bless you, man. I wish you the best of luck. There's 10,000 seniors that are baby boomers that are age 62 and above, and I'm going to be able to help some of them. I can't help everybody. But think about this in your situation if you're going to be persistently thinking the reverse mortgage is not the way to go. When you are going to refinance your house, whether it's because you've paid off the house and you need to pull some money out, or you're going to continue on this path that you're in and you want to get a line of credit, assuming they're going to be available to get a line of credit, or you have a situation where somehow you're going to have to be up for credit approval by the bank. This is the criteria that the bank is using, and like I said, it's nothing new. It's what you've always seen when you were trying to get approved. So the appraisal is out of your control. You don't have any say-so. The program, to a certain degree, you do have some control over it, because you can say, I'm going to pick a 30-year mortgage and that's going to be the higher rate, or I'm going to get a 7-year fixed. Maybe your credit score is excellent and it won't be an issue. And maybe you've paid down your mortgage long enough so that your loan to value is not at 80%, maybe you're at 50%. Well, what's going to happen? And you tell me that I'm going to take some cash out and the Fed rates has done whatever it's going to do. This section over here, your employment income and how much money you're generating. When you're 75, 80 years old, you're not working anymore. Your primary sources of income are going to be predominantly your savings that you draw from to supplement your monthly income, your Social Security, and maybe if you have a pension. Now, another thing to consider, which we're going to again talk about when I flip this over, is that right now you have two incomes, possibly from one spouse and the other from both Social Security and everything else. God forbid one of them goes to a long-term care facility or passes away and that income goes away, that's going to have a drastic measure and impact to your ability to qualify. Because here, what are we talking about? We're talking about income, reserves, and debt to income ratio. And when you were working and you were generating income, having a mortgage for 30 years made sense. And that's what this conversation is all about. I'll give you a little bit preview. You would start off with a higher loan amount and you would have a 30-year period to pay it off. And that's you at age 30 getting a mortgage with the ideal idea that by the time it's 55 or 60, you've paid it off. Now you're 65, 70, and you're on this track for another 15, 20, 25 years of mortgage. And I'm going to get into that conversation. So I just want to focus on this. So that's why it was important that we establish this and be able to see every problem that I see as a potential nightmare waiting to unfold if you continue on the path that you're in with a traditional mortgage, because there's a lot of moving parts here and there's very few moving parts there. And if you're looking for a long-term picture of being able to sustain your fixed monthly income, you're going to have to take some active measures and make some serious choices. And the more you can see every problem from a different perspective, from a different consideration, the more likely you are to be able to see other people and get outside counsel, whether it's a financial advisor, whether it's a CPA, whether it's an estate planning attorney, whether it's a realtor, and to be able to really see this from a global point of view. Because this initially started off as how do we determine what the loan amount is for a reverse mortgage and what the loan amount is on a traditional mortgage. But when you start going deeper and peeling back the layers and you start thinking, I'm not going to get a reverse mortgage and I'm going to stay with what I have, well, there's a lot more considerations. And in fact, there's a lot more considerations behind this board when I flip it and we go over it. That's why when I thought initially it's just going to be a two-part video and I started going into it, I'm like, wait a minute, this is a lot more significant and I can't just cover everything in one video. So I'm going to chunk it up. Okay, I thank you for watching this video. I'm going to make the next one probably right after some point today and put that up. And I appreciate you if you like this and you could share this with a fellow professional. If you're CPA or an estate planning attorney or financial advisor, please share this with your clients. This is a conversation you guys need to be having with your clients with their income. And I'll see you on the next video. Thank you very much. God bless you, and thank you for being my client.